Before investing in the stock, as an investor, you need to look all the financial aspects. Here are few important factors to consider to ensure the quality of the stocks. Like value and health of the company means how much company valued and how much money they have to operate the company. What is their business and how they are generating their income? How is the company's leadership and management and the company's past performance and future returns? Today we are going to see much more about value and health of the company. Knowing the value of the company and company's health is very important for every investor to protect their investment from their losses. Let us see some important indicators to identify the value of the company and health of the company. The first one is the market value. The market value is a measure of how much the market values a company or how much it could cost to buy the stock. And the market of equity changes throughout the trading day as the stock price fluctuates. The second one is the intrinsic value. The intrinsic value is an estimate of the actual value of a company separate from how the market values the company. So the value investor look for companies with higher intrinsic value than the market value and they see this is a good investment opportunity. The third one is the book value. The book value is the worth of a business according to the company's record or accounts. And the book value represents the value of all the asset if liquidated. Price per earning ratio. How much investors are willing to pay per dollar of earnings? It helps investor to determine the market value of the stock as compared to the company's earnings. And if you want to know more about the PE ratio, there is a link in the below description. Asset and liability. An asset is something what the business owns. So, common assets account include cash or bank accounts, accounts receivable like money owed to the company by their customer, inventory, fixed asset like buildings, machinery or furniture, and investment. Intangible assets like patent, trademarks and copyrights. Liabilities are accounts payable like money owed to the company by vendors, business loan and amounts owed to customer for gift certificate or prepaid services. Increasing the liability year over year represents that the higher risk of the company. Debt to equity ratio. The debt to equity ratio is used to identify whether the company is operating based on the loan or based on the capital from investor. And there is a link in the below description if you want to know more about the DE ratio. Now thank you for watching. Make sure to like and subscribe.